Ever wondered why mutual funds come in classes like A, B, and C? What's the difference and which one is the best fit for your investment goals? Today, we'll unravel this mystery. The world of mutual funds can be a labyrinth of terms and conditions, but understanding the different classes of mutual fund shares can help in navigating this maze. The three main classes are A shares, B shares, and C shares, each with their unique characteristics and fee structures. Class A shares often come with an upfront sales charge, known as a front-end load. This fee is deducted from your initial investment. The good news is, the more you invest, the lower the percentage you pay, thanks to a feature called breakpoints. This makes Class A shares a good choice for long-term investors who plan to invest a substantial amount. In contrast, Class B shares have a back-end sales charge. This means you pay the fee when you sell your shares. The fee decreases over time, so the longer you hold your shares, the less you'll pay when you sell. These shares eventually convert to Class A shares after a certain period. However, B shares are becoming less common these days due to regulatory focus on fees and competition from exchange-traded funds. Now let's talk about Class C shares. These shares have a level load, which means you pay an annual fee for as long as you own the shares. The fee is usually lower than the front-end load of A shares or the back-end load of B shares. But remember, since you pay this fee every year, it can add up over time. This makes Class C shares better suited for shorter-term investments. The choice of share class depends on factors such as your investment horizon and the amount you plan to invest. It's crucial to read the fund's prospectus and consider your individual circumstances when choosing a share class. To summarize, Class A shares are best for long-term investors who can invest a significant amount upfront due to the front-end load and breakpoints. Class B shares are less common now, but they can be a good choice if you plan to hold your shares for a long time and want to avoid upfront fees. Finally, Class C shares are ideal for short-term investments due to their lower annual fees, but remember, these fees add up over time, so the next time you're considering investing in mutual funds, remember these classes and consider which one suits your investment strategy the best. Remember, the right choice can make a significant difference in your returns. Happy investing! Now that we've covered the basics of mutual fund classes, let's take a look at two of the biggest players in the mutual fund industry, American Funds and the Vanguard Group. American Funds, part of Capital Group, is one of the oldest investment companies in the world. With a history dating back to 1931, they're known for their long-term investment strategies and superior customer service. On the other hand, we have the Vanguard Group, founded by the legendary investor John Bogle in 1975. Vanguard revolutionized the investment world by introducing the first index mutual fund. They are renowned for their extensive range of low-cost mutual funds and ETFs. These two giants each have their unique strengths and offerings. In the next segment, we're going to dive deeper into the specific mutual funds they offer and how to decide which one might be the best fit for your portfolio. Stay tuned. First up, let's talk about American Funds. As we mentioned, American Funds is a part of Capital Group, one of the oldest and most respected investment companies in the world. They manage over $2 trillion in assets, making them a significant player in the global investment landscape. American Funds is known for their philosophy of active management. This means they do not simply track an index like some other mutual funds. Instead, their team of investment professionals actively manage their funds, buying and selling assets with the aim of outperforming the market. They believe in a long-term approach to investing, focusing on durable companies that can weather economic downturns and still provide solid returns. American Funds offers a wide variety of mutual funds, each with its own focus and investment strategy. Some of their most popular funds include the American Funds Growth Fund of America, which focuses on large-cap growth stocks, and the American Funds Capital Income Builder, which aims to provide a steady stream of income to investors. So, if you're an investor who prefers a more hands-on approach to your portfolio and appreciates the expertise of seasoned investment professionals, American Funds could be a good option for you. They are known for their active management and long-term investment strategy, which has proven successful for many investors over the decades. In the next segment, we'll take a look at the Vanguard Group and their unique approach to mutual funds. Stay tuned. Next up, let's delve into the Vanguard Group. Founded by investing legend John Bogle, Vanguard is known for pioneering the concept of index investing. With over $6 trillion in assets under management, Vanguard is a significant force in the global investment scene. Unlike American funds, Vanguard's investment philosophy is rooted in passive management. They believe in tracking the market, not trying to beat it. This approach minimizes costs and, over the long term, has been shown to outperform many active management strategies. One of the key features of Vanguard is their unique ownership structure. Unlike most companies, Vanguard is owned by its mutual funds and their investors. This means they can focus on delivering value to their investors rather than trying to maximize profits for shareholders. This unique structure allows Vanguard to offer some of the lowest cost mutual funds and ETFs in the industry. Vanguard offers a wide array of mutual fund options covering everything from stocks to bonds, domestic to international, and everything in between. Some of their most popular funds include the Vanguard 500 Index Fund, which tracks the S&P 500, and the Vanguard Total Stock Market Index Fund, which aims to provide exposure to the entire U.S. equity market. So if you're an investor who seeks a cost-effective, passive approach to investing, Vanguard could be an excellent choice for you. Their commitment to low costs, broad market exposure, and investor-centric philosophy has made them a favorite among individual investors and financial advisors alike. In our next segment, we'll compare these two investment giants and help you decide which one might be the best fit for your investment strategy. Stay tuned. Now that we've covered both American funds and the Vanguard Group, it's time to pit them against each other and see how they stack up. First up, let's talk about their investment strategies. American funds leans more towards active management, aiming to outperform the market. They employ a team of investment professionals who research, analyze, and select the securities in each fund. On the other hand, Vanguard is a champion of passive investing, believing in tracking the market, not trying to beat it. They use index funds, which mimic the performance of a specific market index, like the S&P 500. Next, let's compare their fee structures. American funds' fees can vary widely depending on the class of shares you purchase. They have front-end sales charges, back-end sales charges, and even some ongoing fees. In contrast, Vanguard is known for its low-cost offerings due to its unique ownership structure. They can focus on delivering value to their investors rather than maximizing profits for shareholders. Now, let's talk about fund performance. While it's essential to remember that past performance is not indicative of future results, it can still provide some insight. Historically, American funds has had some funds that have performed exceptionally well, while others have struggled to keep up with their benchmarks. On the other hand, Vanguard's index funds have consistently tracked their respective indices closely, providing reliable and predictable performance. Both American funds and the Vanguard Group have their unique strengths, and the choice between them depends on your individual investment goals and preferences. Are you an active investor who likes the idea of potentially beating the market? Or are you a passive investor who prefers the low-cost, low-stress approach of index investing? Your answer to this question might just point you to the right direction. Stay tuned, as in our next segment, we'll discuss how to choose the right mutual fund for your investment portfolio. To wrap up, whether you're investing in Class A, B, or C shares, or choosing between American funds and the Vanguard Group, it's important to understand your investment goals and do your research. We've explored the different classes of mutual fund shares, each with their unique fee structures and benefits. We've also compared two major players in the mutual fund industry, American funds and the Vanguard Group, each offering different investment strategies and fee structures. Remember, American funds leans towards active management with a team of professionals selecting each security in their fund, whereas Vanguard champions passive investing, using index funds to mimic the performance of a specific market index. The fee structures also differ, with American funds fees varying widely depending on the share class, and Vanguard known for its low-cost offerings. While we've provided you with a lot of information, it's crucial to understand your personal investment goals and do your own research. The right choice for you depends on whether you're an active or passive investor, your risk tolerance, investment horizon, and financial goals. Remember, the right choice can make a significant difference in your returns. So take your time, do your homework, and make an informed decision. Happy investing.